Welcome back to today's Financial Explainer. If you've been tracking the markets recently, you are probably experiencing some serious cognitive dissonance right now. Because on one hand, Broadcom is reporting an explosive, absolute face-melting surge in AI revenue. But on the other hand, Wall Street is in an utter panic. Analysts are staring at a projected gross margin decline, and they are sweating. We are seeing a massive collision here between explosive growth and deep institutional fear. And that is exactly the puzzle we are going to tear apart today.
Right, let's just get straight into this tension. Here is the core contradiction that is driving the market crazy right now. In the bull corner, you have an AI revenue stream that just skyrocketed by 143% year over year. I mean, that is literal hypergrowth. But over in the bear corner, you have management guiding third-quarter gross margins down to 74%. To institutional investors, 74% sounds like a giant flashing structural warning alarm. They see that number and they immediately think hardware profits are being permanently compressed. But if you only fixate on that 74%, you are completely blind to the true underlying reality of what Broadcom is actually building.
To uncover that reality, here is our roadmap for today. First, we'll decode the AI margin paradox. Second, a no-nonsense Q2 financial deep dive. Third, the Gigawatt Arms Race. Fourth, the Wall Street Q&A showdown. Fifth, the 2028 computing panic. And finally, we'll wrap with a verdict and turn the debate over to you. Let's get into it.
Section 1. The AI margin paradox. Let's start with the paradox itself.
Why is Wall Street's fear over short-term margin compression completely missing the forest for the trees? Well, because of this number. $30 billion. That is Broadcom's AI booking backlog at the end of the second quarter. $30 billion in locked-in, undeployed capital. This isn't just a financial safety net, it's an absolute reality check against any short-term anxiety over a few basis points of gross margin. The world's largest tech giants are actively hoarding compute power right now, and this backlog basically proves that Broadcom owns the toll booth.
Section 2. Q2 Financial Deep Dive.
Let's strip out the emotion for a second and look purely at the financial machinery driving these results. In Q2, Broadcom delivered a massive $22.2 billion in total revenue. That's up 48% year over year, completely blowing past guidance. And look at how this is structured. 68% of that revenue, or about $15 billion, comes from semiconductor solutions. The remaining 32%, or $7.2 billion, comes from infrastructure software. This brilliantly illustrates Broadcom's dual-engine model. You've got the explosive, high-beta growth of semiconductors perfectly stabilized by the recurring, high-margin cash flow of enterprise software. It's an incredible setup. But the crown jewel? That's the AI semiconductor division. Q2 AI revenue hit $10.8 billion, delivering that 143% growth we talked about. But honestly, it's the acceleration that is truly staggering. Management's Q3 projection points to $16 billion in AI revenue. That is over 200% year-over-year growth. This compounding velocity gave management the bulletproof confidence to lock in their fiscal 2026 AI revenue target at a staggering $56 billion. And for all the analysts hyperventilating over gross margins, just look at the actual operating leverage here. Q2 operating margin hit 67.3%. That is actually up 200 basis points year over year. Infrastructure software annual recurring revenue grew 17%. They generated $10.3 billion in free cash flow in a single quarter. That's 46% of total revenue. They even paid out a 65-cent per share dividend. Gross margin mix shifts are honestly just noise when your operating margins and cash flows are this heavily fortified.
Section 3. The Gigawatt Arms Race.
Now, we need to talk about a massive paradigm shift. If you're out there still evaluating semiconductor companies by how many silicon wafers or individual chips they ship, your models are officially obsolete. The new metric of the AI era is the gigawatt. Broadcom is no longer just selling a chip to plug into a motherboard. No, they're deploying end-to-end compute capacities that require national grid-level power. The scale of AI infrastructure is completely mutated into massive energy and engineering megaprojects.
And this timeline brilliantly illustrates exactly who is buying up all that power. We aren't talking about speculative projections here. These are signed multi-year capacity commitments. In fiscal 2026, Anthropic is deploying over 1 gigawatt of Broadcom compute. In 2027, OpenAI brings online 1.3 gigawatts, and Anthropic is taking down an additional 5 gigawatts of next-gen TPUs. By 2028, Meta will deploy 3 gigawatts of their custom MTIA XPUs. Broadcom has successfully hardwired itself into the central nervous system of the most powerful AI labs on the planet.
And really, it is precisely because of these locked-in, gigawatt-scale mega deployments that management could casually drop an absolute bombshell on the earnings call. They stated that for fiscal 2027, they expect AI semiconductor revenue to sustain at over $100 billion. I mean, the sheer visibility required to project a $100 billion baseline years into the future, that is practically unheard of in hardware.
Section 4. The Wall Street Q&A Showdown.
Of course, none of that stopped the fireworks during the earnings call. Let's move to the Wall Street Q&A showdown, where analysts basically went straight for the throat. The sharpest moments came when they went on the attack over margins. Here's question number 1. Is the massive growth in lower-margin custom silicon structurally diluting your overall profitability? The underlying accusation was blunt. Are your custom AI chips actually a low-margin trap? Well, management fired right back. They said, look, this is a pure mix shift, and it's being massively offset by high-margin AI networking, which actually made up nearly 40% of Q2 AI revenue. Furthermore, they draw a hard line, completely refusing to dilute margins by chasing low-margin rack assembly. But then came question number 2 from the analysts. Are your biggest clients, specifically Google, secretly moving their silicon in-house? Management brutally dismantled that narrative, pointing out they just signed a multi-generation TPU and networking extension with Google back in April, which led directly to the third aggressive question of the call. Is Broadcom just acting as a financial backstop to prop up Anthropic? Management's response was definitive. No. They are providing direct, physical compute capacity via custom TPUs. They're selling raw power, not financial engineering.
Section 5. The 2028 Computing Panic.
So the absolutely crucial point here is understanding what is actually driving this unprecedented demand. Why is there a $30 billion backlog when they only shipped $10.8 billion in Q2? Well, it's because we are literally witnessing the 2028 computing panic. The bottleneck for AI is no longer just getting silicon out of TSMC. The real bottleneck is the physical power grid itself. Data center build cycles now take years due to power and infrastructure constraints. Because lead times have extended so dramatically, cloud giants are absolutely terrified of being left behind. They are panic ordering custom silicon for 2027 and 2028 today just to ensure they have the physical capacity to train the next generation of frontier models.
Now, what is really fascinating about this monetization model over the long term is how Broadcom plans to extract value from this panic. While the dollar value per gigawatt is relatively flat in the short term, the long-term mechanics are incredibly bullish. As AI architectures evolve, Broadcom's custom XPUs will utilize complex, multi-die designs, and crucially, they'll begin embedding CPU functionalities directly onto the silicon. What does this mean for us? It means that for every single gigawatt of power deployed in 2028, Broadcom will be extracting a significantly higher dollar amount of content value.
Section 6. Our final verdict.
Okay, we've broken down the financials, the Gigawatt Arms Race, and the structural panic driving that massive backlog. It is time for the final verdict, and I want you to weigh in on this. Look at the reality of the data. Does a projected 74% gross margin actually signal a structural warning light for hardware profitability? Or does a $30 billion ironclad AI backlog completely neutralize that fear, making gross margin an irrelevant noise metric in the face of absolute market dominance? Drop your thesis in the comments below. I really want to see the bull and bear camps battle this one out.
And hey, before you go, you need to dictate our next move. Today we saw how Broadcom is building the custom silicon empires for the biggest players on Earth. But whose specific architecture should we tear down in our next deep dive explainer? Do we decode Google's multi-generational TPU empire, Meta's MTIA evolution, or OpenAI's highly secretive chip roadmap? Vote in the comments. Your choice directly controls our next financial explainer. Stay analytical, stay focused, and I will see you in the next one.